Hey guys, welcome to this video. I'm going to do a full rundown on the euro pound for you now. It's going to involve fundamental and technical analysis. Of course, do feel free to like, share, comment and subscribe. I've been posting a lot lately and I will continue to do so. And of course, get my free training underneath. The link is just under the video. So what have we got? Well, I'm going to start things off on the very long term, and I'm looking at the monthly at this point. We're going to take the data on TradingView back to 1975. Okay, you can see over that period we've gone up and up and up significantly. So you can see that the pound has lost value, the euro has, of course, therefore gained against it. Now, that is, as I said in my last video, very much down to central bank rates. Central bank rates between economic zones, in this case the Eurozone versus the United Kingdom, when they vary, that's what causes this deviation in price. That is what causes the euro to accelerate in value over the Great British Pound, because of course the distribution of money or the distribution of that currency differs in different parts of the world. Some places it's easier to borrow, some places it's better to save. Okay, it just varies. So that's what causes the long-term trajectory. And it's really important to understand that, because once you understand what is pulling a market a certain way, it allows you to make an informed decision bias for the long-term market. Okay, it's just like knowing how anything works. Okay, you need to know, if you want to ride a push bike, a bicycle, you'll need to know, or I mean, you don't specifically need to know, but everyone knows that it's got a chain, the motion of you pedaling pulls it round, and the bike moves forward. Okay, it's the same trading currency markets. What is pulling the chain round and what is moving that market in a certain way? Okay, so that's the first thing to establish. Now, if we just zoom in slightly, the bit that's relevant really to us is the data from this point here, where I'm drawing a line, September 2016, to this point here. Okay, these are the relevant points for the near term. And the reason why is because if you look to the upside, there's various levels of price action rejection. Okay, you can see that all around. And if you look to the downside, you can see there's various levels of price action rejection pulling you up. So any movement towards the downside usually is going to constitute long side bias. And that's exactly what professionals and institutional traders will be looking for alike. And anything that causes a move to the upside, of course, is the flip side of that. It's looking for that short side bias. So that's really what forms those candle wicks. Okay, the reason why those candle wicks appear, again, going to that basic understanding of how markets work, is the fact that people are pulling off their long entries and they're getting short. Okay, so that's what causes the pull down, and that's what's going to allow us to make an informed decision when the price either goes up to this point. Okay, of course, that would change our bias to short, or this point when, of course, we would get nearer this 200 MA and we'd be in line with key price action levels to the long side. In other words, the opposite of what I just said, which is people are taking off those short entries and they're flipping to the long side with a renewed long side bias. So this represents the long-term market, and this also forms a sideways choppy market. In other words, a price range where the effects of the central bank and the effects of the global economy are not deviating this pair apart very much. And therefore, what happens is you get a range between an average of 0.908 to about 0.843. Trading it, therefore, becomes extremely predictable. And if you've just seen 7 years of the same thing, if you just spent the last 7 years trading it as I've labelled it, easily enough, you would have made money. Okay, obviously there's a lot more to it, and that's mainly why I teach people around the world how to do this stuff. It's a lot to do with risk management, but that gives you your overall trajectory. So you know long term the market is pulling up, and therefore it's perhaps likely that at some point you're more likely to break out to the upside, okay, because of the change in the two global economies. But you're still aware if you do pull down here, it's going to constitute a long entry right about your key 200 MA. So you get a long-term bias by doing these simple things. You get a long-term outlook of where the market is going to go based on what you can see right ahead of you. Of course, in my case, and in your case, if you're looking at this chart, it's a sideways choppy market that is ascending to the upside every so often. And you can see that's exactly what happened here, okay? the market went to the side, but it actually came down first before it comes up further. Okay, so you may experience that, but nonetheless, over the very long term, you look to the upside. Now, for those of you who are looking nearer term, much more of my style, and what I mostly teach people, instead of looking since 2016, we can actually just cut a few years out of that and look from about 2020 onwards. Now, when you do that, what you do have is a high here, followed by these levels, but mainly your push up here is where you've had the last significant rejection. If you look down here, you've got a low, and you look there, you've got a low. So you've got this slanted sideways movement, which is exactly what we just spoke about. Okay, like I said, anything down here is going to be ideal for a long. Now, you might find that if the price does actually end up coming down here, slightly below this low, just like you had at this point, okay, where you would have had institutional buying or large money market buying, you might find you just come under this slightly again, okay, similar to what you've already seen before. And that will coincide nicely with key price action levels there, okay? So that would continue to represent a slanted downtrend on your weekly time frames, okay? So your overall uptrend can be reflected on the yearly or more, because it's over 1975 to now, it's like 50 years. There's no point in using like daily time frames for that, because it's not going to help you at all. And that would give you predetermined long zones. So anything nearer to all of this is where you would start to look to get out of those shorts and start to get to the long side. I know that's a long-term outlook, and I am going to swap in a sec to nearer terms, but really investor longs are going to come down there. And if you want to get short, okay, I would suggest probably, in my case, I would enter a lot higher up. I think that's probably where you'll get. And if you're a long-term short trader in this market, which would coincide with what you've seen lately, or at least for the last few years, that level is far more ideal, and especially doing it with impulse. You've got what seems to be the early start of a larger push coming straight into this resistance. Okay, so we're now going to talk about the nearer term and what you could experience via this resistance before you end up getting here, because it's unlikely you'll shoot up like that straight away. So what I'll do now is I'll swap to the daily for that. And you can see on your daily, you've just popped above this previous high, much like what I was saying before. Okay, market maker stops. People place their stop loss as it gets closed out and the market falls. And this really just comes in line with this key price action here. This was a really good short entry for the very near term. I spoke about it with members and non-members across the board. And that was really good as an entry. I wouldn't be totally shocked if you do come back to this level of key price action that I'm now drawing now. That really wouldn't surprise me at all. Okay, so I'll denote that as a blue line. And that's going to help you because it's going to come back to your nearer key price, your nearer key moving averages as well, which within an uptrend on your daily is very, very handy, okay, because you have got higher highs and higher lows. So what I'm trying to get you to understand here is although you're trending down on the weekly, you're trending sideways on the monthly, and you're trending up on the daily. Normally, if you're a new trader, that causes, whoa, I'm confused, I'm scared, because everything is, people use the word divergence. And it's okay, that's okay, but it's all about understanding the machine as one. Because time frames are organized in terms of data, and the data differs for every single period, because obviously if you're looking at the daily rather than the weekly, you've got seven times more candles to look at. Therefore, your indicators and your trends are going to be stretched out over a longer period of time, and hence that is why you'll have a differing indicator or a differing trend. Okay, it's really easy actually. People don't get that, but it's really, really easy because you're looking at a different time frame. The data, although it's the same price, it's not arranged in the same way. Okay, and you'll often notice if you put your time frames up or down, your stochastic oscillator moves. Okay, so on the monthly it's down here, like I said, and on the weekly it's up there. Okay, it's because there's a big jump from weekly and monthly and weekly to daily and daily to hourly. Okay, it jumps a lot. There's 24 hours in a day. It's going to move the data out 24 times. So that is why things diverge. But as long as you've got that long-term bias, like I said at the start, and you understand the long-term market trajectory, you can trade near or long term with controlled risk. So I wouldn't be shocked if your daily uptrend does continue, but first I would probably expect it would come down here. If you do end up beating that high, I think you'll come up to this point, and all of this will start to cause a problem for anyone who's trying to hold along, and it would much more be preferred as a short zone. And it's just because you can see so much rejection here. You'll notice I label rejection all the time, and it's just because it's what is probable. It's what makes probability occur. It's just based on what you can see. So in the near term, like I said, I wouldn't be surprised if you pull back. In the further term, I wouldn't be shocked entirely if you move up on your daily uptrend. That is going to coincide nicely with your weekly chart, which, as I said, is moving sideways slightly to the downside. If you go on your monthly, rather, you can see, because you've come up here so many times before, it might be said that it's relatively likely that you'll end up here again. Okay, and I wouldn't go against that at all. That's what you've seen for the past 6 years. Why would it stop now? Or 7 years even. So I should think at some point you'll get up here. There's short and long entries you can take based on those lower time frames. In between that, as I described on your daily, you can look 4 hourly as well. That will tell you the same story. And of course, it just becomes a case of understanding that if you're going to come down here, that is going to be a preferred long zone. And of course, if you do continue to the upside, that is going to be a preferred short zone. And it all comes together with a multi-time frame analysis and an understanding of the long-term market and where we're likely to end up based on what you can see, like you can see with these levels here of support and price rejection. So thanks for watching, guys. Another full in-depth analysis. If you want to see more of it, subscribe, like, share, comment, get my free training underneath. And of course, I look forward to seeing you in the next one, guys. I'll see you there.